And we are honored and we are privileged that we have the chairman of the SEBI, the investor Takat. So may I request the Honorable Shri UK Sinha for his valuable insight and the word of wisdom. Thank you, sir.
Good morning, everybody. I wish to express my thanks to the Institute of Company Secretaries of India for giving me this opportunity. In fact, when Mr. Sahu brought this idea before me, I was more than happy to be here with this special group of company secretaries in India. I'll explain to you why I myself wanted to be interacting with you and have a dialogue. Basically to tell you what SEBI has been doing and why we have been doing what we are doing. Earlier speakers have talked about the triple mandate of SEBI and how SEBI has to work in areas of regulation, development, and also investor protection. And some mention has been made about the primary market, secondary market, and the mutual funds. But I will take this opportunity today to talk to you about an area which I think is very important from your perspective and also from SEBI perspective. That is the area of governance. If you see that the securities laws and the companies law, these are two sets of laws which converge at corporate governance. Both these laws converge at corporate governance. And market governance and corporate governance are very, very closely interlinked. Two important developments have happened. One is the Company Act 2013 has become effective. It was passed by the Parliament. It has been implemented. And SEBI has come out with its own set of regulations about corporate governance. In various parts of corporate India, including media, SEBI is being accused of being an activist. In some places, even stronger words are being used against SEBI. But I would like to explain to you that what has been the thought process. If I begin with the larger development in the social and political life in India and outside India, especially post the global financial crisis, you will discover that all over the world, in various parts of the world, starting from Egypt to Turkey, to Rio, to Tunis, and on the streets of New Delhi, people who have earlier not been part of any political process, who are not directly connected with an issue, they are coming out to express their opinion, their anguish, their anger in hundreds of thousands on issues which do not directly connect them. Earlier, such outbursts used to happen once in a while, but particular clientele used to be a group of young students or some unemployed people. Today, that is happening. What is drawing people are the type of people who are being drawn are young professionals, self-employed people, people for whom time is of great value, but they are so agitated over a particular social or political issue that they don't mind coming out of their homes and offices and spend hours together. And it is having its impact because people now are expressing in the social and political life that their voices have to be heard. Regime changes are happening. There is no fixity of tenure. People are being removed well before their time from important positions in public life. There is a continuous and comprehensive evaluation going on. It stands to reason that if this is happening not only in India but all over the world in the larger social and political life, it has to happen also in the corporate life. It stands to reason. So many of the things which the Parliament is doing or which SEBI is doing, if we start comparing that in the larger context of the societal developments, perhaps we will be able to better understand it and better adapt to it. Let me also begin by saying what is happening in other parts of the world so far as corporate governance is concerned. Corporate governance has got legal and ethical aspects. Now, ethical aspects cannot be defined. It's very difficult to define them. So you have to follow certain principles. And the principles which we are following in India and many regulators or governments across the world are following have 2-3 important components. One is equity and fair play across the investors, across the shareholders. Transparency in information dissemination. Integrity in the financial reporting system. And of course, predictable legal and regulatory environment. If you look at the United States, for example, after the global financial crisis, the commission which was set up to get into the aspects of what went wrong, the most important recommendation which they have made is, or the finding that they have given is that it was a complete failure of corporate governance and risk management in large financial firms, which was the most important reason for the global financial crisis. This is a report given by the commission which was set up by the government of United States. If you look at some of the events which have happened globally, then you will perhaps realize that why there is a cause of action on the part of the regulators. In one particular case, a large financial firm suffered huge amount of losses because they had taken a fraudulent position, and the CEO of that company made a very famous statement that why are people talking about a tempest in a teacup? That was their statement. And later, the same company, the same CEO had to go for a settlement of over $10 billion. In another case, the company had taken a very, very defective, controversial derivative position of over $40 billion. And the CEO said that I don't lose my sleep over these positions. And the CFO said that, well, this doesn't attract even a small fraction of 1% of my working time. If this is the attitude, if this is the approach with which companies conduct themselves, do you expect the governments and the parliaments and the regulators to keep quiet? In India, we had one large example of a company continuously, year after year, fudging its accounts, and it affected hundreds of thousands of investors, not only in India, but even outside India. We have one company which claimed that they had raised money through private placement. The only problem was that private placement was made to millions of investors. A private placement to millions of investors. We have example where companies have been raising money for emu farming or goat farming or for so-called suspicious housing schemes. And hundreds of thousands of investors have lost money in those schemes. We have, in SEBI, we have an example, and we had to act after that. We had an example where a company brought a proposal before its shareholders that they want to have money for redemption of their foreign currency convertible bonds, and for doing so they wanted to sell some of the company assets. The shareholders gave the approval, the assets were sold. Only problem was that the FCCBs were never redeemed. The whole money was utilized for buying personal property for the promoter of that company. I'm not giving you any phantom examples. I'm giving you hardcore examples which we have seen in our company, in our organization. We had another case where one company went to buy another company, another IT company, using the company money at a valuation which later turned out to be more than 100 times the true valuation of that company. The only problem was that the unlisted private company which was bought by this company using shareholders' money actually belonged to the promoter. It was his own private company which was bought. We have a third example where a multinational company bought sold a particular IT division, a division of the company, that is the IT division, to its parent company, which was outside India, at a valuation which was much lower than the actual valuation as it turned out. And in this particular case, institutional investors protested. They protested that this resolution should not be passed, but unfortunately the resolution had to be passed because they had the majority. And we had no specific regulations or rules how to deal with a situation like this. In SEBI, we have a computerized system for grievance redressal because we deal with hundreds of thousands of investors. To anybody, it would appear that if SEBI receives grievances or complaints, a major portion of those complaints should be against the intermediaries. You will be surprised to know that almost 50% of the complaints that we received on our computerized system are complaints against corporates on matters like how their dividends have not been paid, how their requests for transfer are not being agreed to, and all sorts of grievances which they have. We have mandated that the companies should come and get listed or get registered with SEBI's computerized system that is called SCURES. I'm surprised that almost 40% of the listed companies in India have, even now after 2 years, not yet registered with SEBI for investor grievance redressal or shareholder grievance redressal. So that is the attitude, that is the situation in which we are working in India and many other parts of the world. So what is the outcome of this? Where is it leading us both in India and outside? In USA, you will find, for example, that CalPERS, the pension fund, they have demanded, and very successfully in many cases, that majority should be there for election of the directors, which means if a director wants to get elected, he must have 50% of the votes. And perhaps you will be surprised that 84% of the S&P 500 companies, they have adopted this policy, that the director's election should be with 50% votes in favor of the election. And in case of a smaller companies, the ratio is around 40% companies which have adopted this. In Canada, the Institute of Chartered Accountants has demanded, and now many companies have started adopting, that if the number of votes that a director has got for his election are less than the number of votes against his election or number of votes which were abstained. So both put together, if his number of votes in his favor are less, then he will not be elected. His polling should be more than that. In United Kingdom, you will find that there is a lot of emphasis now on shareholders' engagement. The Stewardship Code, which has come out in 2012, underlines the role of the institutional investors and how they should be conducting themselves. And they have come out with this concept of comply or explain. The Financial Reporting Council of UK has now come out with a very detailed guidelines on directors' remuneration, on matters like internal controls and risk management, on matters like how the whole affair of the company is going to get conducted. In fact, there is a requirement that the head of the remuneration committee, and remuneration committee head should normally be an independent director, the head of the remuneration committee, if he has made some recommendation on remuneration, and that recommendation is not able to carry 75% plus votes, then he has to seek re-election. Because the assumption is that there is something wrong with his recommendation. if 75% of votes are not received, then he himself has to seek a re-election. There are also provisions for clawback of the variable pay. So a number of these things have happened in EU, European Union. If you see, the counterpart of this is the Shareholders' Rights Directive. In Australia, the Australian Stock Exchange, Ashish was mentioning about how he has been asked by SEBI to ask questions on compliance and on disclosure, and he has been asking questions. But there is example in Australia where the Australian Stock Exchange itself has come out with very detailed guidelines about the listed companies on matters of governance. South Africa again has very strong guidelines through their King Report 3. So there are many examples all over the world where now there is a focus on these areas. And some of the impact of these measures, I'm sure you would be aware, but just to highlight the developments, between 2012 and 2014, and more so in 2014, a number of CEOs of big companies had been forced to resign. The company brought before the shareholders proposals for remuneration, which was shot down. In one case, for a very large financial company based in UK, it was shot down by more than 20% of the voters. And CEOs have been forced to resign in some cases. It is happening increasingly. The trend started in 2012, but now, so far as the first 6 months of, or 7 months of 2014 are concerned, a number of instances are now coming to notice. This is what is happening on the side of the investors or the institutional investors, who are also playing a stewardship role. The other dimension is that what is happening on the regulatory response side. How are the regulators responding? One trend which is very clear is that earlier the regulators used to award penalties to the companies. In the last 3-4 years, what I am noticing, and I am sure many of you are noticing, that the trend is shifting towards not only penalizing the company, but towards penalizing the executives, the key management people. You look at Hong Kong, you look at USA, you look at United Kingdom, there are hundreds of examples where they have started doing that. And the trend is growing, because the feeling is that companies, because of their attitude to regulatory directives, perhaps treat all these penalties as an extra or additional cost of doing business. So now the move is towards penalizing the key management people. And if you have seen some of the provisions of the Dodd-Frank Act in the USA and the rules that have been made there, there are very specific provisions on how to decide the executive's compensation and on matters like pay ratio, matters like golden parachute, listing standards and things like that. So this is the response which has come in the USA. Coming to India, I would say that there are 2 or 3 important trends which are happening or which are taking place. One trend is that there is now a rise in the activity of institutional shareholders. And we must assign some credit to SEBI for starting this. As early as 2008 or 2009, SEBI came out with its directives that mutual funds must have a voting policy, they must have a record of their voting, and it should be displayed to public at large. SEBI has taken up with the IRDA that they should be also mandating something similar for the insurance companies where they are shareholders. The proxy advisory firms have now come up in India, and they are playing a very active role now. 3 years back, maybe we didn't have a single such firm, but in the last 3 years, they have started playing a very active role. And another dimension, another trend which I would like to highlight is that earlier, in SEBI's scheme of things, you could commit any type of offense and come to SEBI for a settlement. We have a mechanism called the consent mechanism. So a serious crime or a not so serious crime, everything could be settled. So in 2012, SEBI has come out with its guidelines that there are certain offenses which are serious in nature. You have to suffer. You cannot come to SEBI for a consent, for a settlement. Settlement is only for minor offenses, not for major offenses. So these are two trends which come to my mind. But if you look at certain developments, and I will particularly mention about schemes of arrangement, we discovered that before going to High Court, the requirement was that companies could file their papers with the stock exchanges, and after that they used to go to the High Court. We discovered in many examples, not one or two examples, many examples, that related party transactions and its abuse were not uncommon. And in order to check that, SEBI has come out with the guidelines that before you go to the High Court, you have to first come to SEBI, and we will be party before the High Court. We will be filing our observations, and then only you can go before that. I am happy that some people challenge this directive, but the judiciary has upheld SEBI's position. So this is the rule of the land today. The Company Act, people talk a lot about Companies Act and how it has created problem for them. There are a lot of private conversation going on, and some public conversation is also going on about how the Company Act has created problems for them. But the Company Act has been in the making for almost 10 years. I don't remember any act in which there has been such a wide consultation at all levels. And when in 2013, this act was passed by the Parliament, I remember the majority view was, the overwhelming view was that it's a great thing which has happened. Why is it that in 1 year, less than a year, we have started discovering problems? A renewed discovery of the problems with the act. What has Company Act done? It has only focused on areas, so far as governance is concerned, on areas like independent directors, on areas like nomination and remuneration committee, rotation of the auditors, related party transactions. Now, if you look at India or various other parts of the world, don't you think that these things are required? SEBI has come out with its guidelines in April this year. And before I come to that, I'll also like to tell you that, and Ashish made a mention of it, we have the listing guidelines, listing agreement from the year 2000, and it has been revised from time to time. The most important revision was in 2003. The listing agreement and the requirements about disclosure, you will be surprised that on one count, that is clause 35 and 36, there were 1100 companies in BSE, 1100 companies in BSE which were non-compliant. And on clause 49, there were 900 companies which are non-compliant. How can we allow this to happen? This has to be stopped. So now, sometimes in September last year and again in November last year, we came out with very detailed guidelines, and we have now said that it is the responsibility of the stock exchanges as the first level of regulator of the listed companies that they must ask questions. Ashish is saying that he has been asking more than 200 questions, and rightly so. Because if there has been such a big violation of the existing rules, some action has to be taken. We in April this year came out with our detailed guidelines about what we expect the companies to do on corporate governance matters. And our basic attempt has been to align with the Companies Act. However, there are certain areas where we have gone beyond that. We have talked about the independent directors. SEBI is of the view that a nominee director should not be counted as an independent director. We have talked about prohibition of stock options to independent directors. We have recommended a separate meeting of the independent directors without the management at least once in a year. We have talked about a whistleblowing blower mechanism. disclosure of the remuneration policy of the company, expanded role of the audit committees, pre-approval of related party transactions by audit committee, internal auditor to report to audit committee, but this we have kept as a non-mandatory. This item is not a mandatory item, this is a non-mandatory item as of now. We have asked for representation of women member on the boards of directors. We have talked about evaluation of the boards, evaluation of the independent directors, and evaluation of the risk management plan. I'll also like to tell you that we had earlier got a provision where we said that in disclosure the promoter shareholding should be disclosed regularly, and there is a mechanism that on event based or on a quarterly basis it had to be disclosed. Then we found that pledging of shares were not getting reported. When we talked about pledging to be reported, a new avenue, a new instrument was discovered or identified, that is non-disposal undertaking, NDU. So it has been a chase for SEBI. So finally we caught up, we said, okay, even NDU you have to disclose. But I'm giving you these examples to make the point that there is need for a serious change in the attitude about compliance, and you have to have an attitude towards giving respect and value to your minority shareholders. Let us not forget that if we want India to be a trustworthy destination for investors, large number of foreign portfolio investors are investing in India. In fact, the data is known to you, but it is very important to note that the growth in the market, especially in the last 1 year or 2 years, is primarily because of the fresh inflows from the foreign institutional investors. And while the foreign portfolio investors or foreign institutional investors come to the country based on their projection of the growth of the economy, projection of the earnings of that particular company where they are investing, they want to be sure about the legal and regulatory framework. They also want to be sure about the governance practices. And they want to be sure about the financial statements that are produced. Several senior foreign portfolio investors who have met me have confided in me that between India and another large Asian country, they prefer India because they are more comfortable with the legal environment here and about the corporate governance practices here, which they are not sure about the other country. So friends, this has to be taken as a positive movement. Governance should not be taken as a restriction on you, as something which you are being forced to do. This is something to your own benefit. Let me also remind you that while foreign investors are coming in, portfolio investors, we have not been able to convince these trustees of provident funds in India, even today, that they should invest their money in the Indian stock markets. There is a directive from the Ministry of Finance. There is an investment guideline from the Ministry of Finance that 15% can be invested in the equity market. But even today, the trustees are not yet convinced that everything is right in the Indian market. And I would expect all of you, especially as members of the company secretary fraternity, to work hard towards the day when you will be able to convince the largest trustees of the pension funds in the country that they can invest in the Indian market and things are well regulated, well governed in the Indian market. That should be one of your tasks. There have been also representations to us that while we are doing all this, we should not go to a distance or travel a distance where it becomes very, very cumbersome on the part of the companies. And I would like to assure all of you that we will be very consultative, and we will at every stage try and modify if we feel that there is something which we have done is not practical or should not be implemented at this stage of our development. We had received some representations that how is SEBI going to safeguard, for example, against the avoidance of conflict of interest in case of proxy advisor. You may be aware that we have now come out with our requirements of regulation of research analysts, and we have covered the proxy advisory firms on issues of avoidance of conflict of interest, on issues of disclosure, on issues of prohibition of trading for a certain period and a certain time window. So I'm giving this example that we will be always ready to listen to industry to decide what is in the best interest of the industry and the country at the current stage of our development. But let me also tell you a story, and it is a strange coincidence that this has happened in the last 3 weeks. Two large company chairmen, one in the services industry and one in the manufacturing industry, independently over a gap of about 2 weeks met me. Interestingly, both of them had a list of issues with SEBI. I leave it to your judgment that who could have provided that list to them, whether the compliance officer or the company secretary provided that list or somebody else provided that. I leave to your imagination. And I engaged them individually in a dialogue. And when I engaged them on point by point, both of them agreed that 80% of the demands which they were carrying in their paper were redundant. They conceded that what SEBI has done is right. But somebody had given them those papers. For example, one of the chairmen who met me, he said that, no, why are you asking for evaluation of the boards? But after some time, he himself agreed that, yes, it's a very good thing to do, and I'm going to implement it. So my message to the company secretary fraternity is that instead of having an attitude of a pushback from the status quo, because if you are having an attitude that if there is any change in a status quo, there must be a pushback, please refrain from it. Look at it from the medium to long-term growth of your company. Look at it from the medium to long-term growth of India. And if you still find that there are areas where SEBI must look back, I assure you that we will do that. But we must try to make India a very trustworthy destination. Right now we have these guidelines or the listing agreements. We have already announced that we are going to now introduce listing regulations. SEBI team is working on it. Very shortly, we will have our listing regulations. And as company secretaries, I'm sure you are aware that the regulations will have more force of law than the current agreement. I'd also like to leave one last message with you, that in our April guidelines, we have said that those guidelines will be effective from 1st of October 2014. Now, less than 2 months are left. And my own understanding is that there is large amount of area that still needs to be covered. So I will urge you, I will request you, please convince your management, please take it as a task for yourself that you have to be prepared for it. If we are able to do that, if we are able to generate confidence and trust in the investor community, believe me, we are as a country at a situation today where no other power in the world can stop you. I wish you all the best, and thank you for inviting me.